Hello, everyone. Welcome to Rational Investor, your bi weekly reality check on investment, personal finance management, and macroeconomy. It's our first episode today, and we are going to discuss about a very timely topic investing in times of high inflation. Now, towards the end of this discussion, we are going to take a few light-hearted questions, including our guest favorite book recommendation for an investor and also his favorite person to invite for a dinner party from the industry. So, stay tuned. Now, my guest today is Soham Das. He has 13 plus years of experience behind him in capital market industry, specializing in emerging market equities, global leverage funds, and global macroeconomy. He has previously worked in hedge funds and at wealth management desk of US and European international banks. In addition, Soham invests in Indian markets primarily with a strong focus on microcap investing blended with a top-down global macroeconomy check. The composite portfolio under his management has yielded returns in excess of 38% CAGR over the last 5 years. So, Soham, welcome to Rational Investor.
Thank you, Vajira. It's an honor and a pleasure to be on your show. Thank you
I'm
for inviting me in.
absolutely thrilled to have you here. So let's do this. To start off, the about the choice of topic. Now, inflation is running hot everywhere. Frontier market, emerging markets, developed markets. Nobody's left behind. And central banks have been behind the curve for the longest time, and now they are unapologetically trying to tame the inflation, and that at the expense of growth. So, the big question is in times like this, what are the investment and asset allocation themes an investor can look at? So, let's begin from there.
Thank you, Vajira. It's really an important and pertinent question. Let me start with the short answer first. In times like these, when a raging hyperinflation is on, investors should really focus on any company which is A, asset light and or intangible asset centric. Let me tell you why. In times like these, investors should always be cognizant of the real economic earnings that they will enjoy and not just focus on accounting earnings. When accounting earnings is matching with the real economic earnings, we can really say that the accounting rules and principles and guidelines are really working as intended. But we must be cognizant of the times and the instances when they do not. Because we have to understand this point that the very raison d'etre of accounting principles to exist is really to report economic earnings reliably, consistently, and in a standardized way across time frames and companies. But the problem is that accounting principles themselves are a victim of skewed rules and discretionary stances. Let's take fixed assets, for example. Companies are not allowed to mark up their fixed assets, keeping in tune with the times when the current replacement cost rises. As a result, a fixed asset is always carried at book. So, what really happens is the depreciation, which is a function of how much asset is carried on the book, is also running as per the historical cost value. Now, this is all right because the assumption is I, over the course of the lifespan of a machine, I charge some amount of depreciation per year, put them together, and at the end of the lifespan, I spend that amount and purchase a new machine.
Hmm.
The tacit assumption is that the price of the machine will not really change, and that is okay because price stability is really built in with the modern capitalist system. But what happens when there is no price stability? When inflation and hyperinflation as such rolls in. So a asset purchased at X price becomes 3x overnight. As a result, the depreciation which should have been charged is always undercharged on the accounting books. So let's take a very precise example. Let's take a Sri Lankan company which has purchased a fixed asset worth 100,000 Lankan rupee at the start of the year one. Its useful life is 10 years. So the annual depreciation charge that will be shown in the P&L statement will be 100,000 divided by 10 because it's a straight line depreciation. So 10,000 Lankan rupee every year.
So that would
The
be the blue bar.
pardon? Yeah, exactly. That is the blue bar. There is a blue bar. And because there is price stability, let's assume there is, the machine is also current market price is similar, maybe $105,000 Lankan rupee or 110,000 Lankan rupee or something like that. So the effective depreciation that should have been accurately shown and that is actually shown, there is not much difference. Perhaps 500 Lankan rupee over there, 1,000 Lankan rupee over here. That's it. But what happens when the same machine really changes price because inflation has come in? 100,000 worth Lankan rupee machine might be trading at say 300,000 Lankan rupee and is available for that much amount in the market. And I don't mean financial market, I mean general industrial markets. Where is that 200,000 rupee shortfall going to come from? That is going to come from investors' pockets after all. So what does it really mean? It means that the depreciation that should have been shown in the P&L statement, had there been a restatement of the fixed asset, is far more than the depreciation that is actually shown today in today's circumstances. As a result, the depreciation is understated, the reported depreciation is understated compared to what should be. As a result, earnings, accounting earnings, is overstated compared to the actual earnings, actual economic earnings an investor enjoys. What the conclusion really implies is this, that it's a problem where
Hmm.
the investors are at the losing end. So, this entire problem really rears up badly in cases of asset heavy companies in inflationary times. Keep lowering the assets or the asset intensity of a company, make it more and more asset light, this understatement problem or rather overstatement problem vanishes. To the extent where if you make it completely intangible asset heavy, for example, a technology company, a brand, a brand products company, FMCG company, a service, human resource based service company, a product based company, all of these suffer from an understatement problem. The reported earnings is actually understated compared to the real economic earnings that a shareholder enjoys. The reason? Because all the investing expenses are expensed out from the P&L, because just because they are going into building brands, they are going to building R&D, they are going to building human resources. So the conclusion really is that asset light in, asset heavy out. And that's a theory. I mean, that's well and good. But if we really want to test this, It is better to actually build a kind of a ratio where we are basically testing companies and their performance over a period of 5, 6, 7, 8, 12 years or 15 years of period on this aspect to test out this phenomenon. So what we did was we built a ratio where we are kind of summing up the capital investments over a period. It was 5 years for our case, and for the results that I'm going to show, and sum up the depreciation. The closer that amount is to the capital investments, uh, capital investments, better it is, and lower the ratio will be. If depreciation is much more than the capital investment, then the ratio will be less than one. If actual capital investment is far, far more than the depreciation, the ratio will be higher. So the lower the ratio is, the better it is for investors. And we sorted that out in terms of quintiles. So top 20% of the companies will be quintile one, and top 20% as in the companies with the least ratio will be the top 20%. The most
Right.
ratio will be the bottom 20%. So, and when we checked it, we ran it on Indian markets and the Sri Lankan markets, we found that there is a tangible alpha to be had. You go long on the companies who understate their accounting earnings, and go short on companies which overstate it. You create an alpha of up to 6%. You go long in the first and second quintile, and you short the fourth and fifth quintile, you create an alpha of 5%.
Wow. Okay. This is phenomenal. So did it yield the same results? You know, this cap date results. Did it yield the same kind of results for both Sri Lanka and India?
No, this is a mix. The universe that on which it is tested was a
Okay.
combination of Sri Lankan and Indian companies.
Okay.
So your Colombo All Stock Index and NSE 500 was mixed together to
Okay.
build it. Yeah. So you can see the quintile one and quintile two, that is the companies with lower cap dep ratio, that is capitalization to depreciation ratio, are outperforming the ones with a higher capitalization to depreciation ratio. So yes, so what the bottom line is, theory matches with the empirical results. Good news.
Well, this is phenomenal. I mean, to be honest, this is not a ratio I've actually looked at, and that's actually very interesting point
It's a
that
it's
you put forward.
Right, right. It's still not popular because it is a reasoning from the first principles, and I really have to acknowledge the work that OSAM has done on this. O'Shaughnessy Asset Management has done on this. It is basically their initial idea, their research on the U.S. markets that brought this idea forth. What I did was I just invented, or rather transplanted that idea for our emerging markets, and lo and behold, it works because it's starting from the first principles.
Right. This is just phenomenal. So I think overall, to sum up what you said, I mean, it's this emphasize the importance of scrutinizing the financial statements, like
Indeed,
especially in times like this, in identifying the impact on economic earnings. Now,
indeed.
yeah, yeah. I mean, no, you're going to like this now. Now, to drive the point home, I remember some time ago I read this article on CFA Institute website, and I really like this quote from Abraham Briloff. He's an accounting scholar, and he said that financial statements are like fine perfume. They are to be sniffed, but not to be swallowed.
Very well
Yeah,
spoken. Golden words, actually. Yep, true.
absolutely, absolutely. So I guess the bottom line is asset light companies are in, and I believe
Yep,
preferably the high margin, the one with the greater pricing power,
yep,
and that would be one of the best places to be in when
yep,
inflation is running hot.
yep.
So on that notion, how would be the ideal investment playbook would look like, in your opinion?
In inflationary times, it is simple. Go asset light. Go into those companies which are intangible assets heavy, even companies with a pricing power, companies who earn in uh, USD but spend in Sri Lankan rupee. So you combine these parts and you really have something very interesting over there. They will at least protect you and your purchasing power to a certain extent, to a certain extent, uh, till inflation rolls in. But remember this point that capitalism and stock market and equity performance, all these things are really a function of how well a society is performing. Inflation really hits at the trust center of a society. Can I trust tomorrow's prices or not, or today's prices or not? So a low trust environment is going to be bad for equity. So 20%, 30%, 40% of inflation that Sri Lanka is seeing should be okay with these kind of equity assets. But any country which sees a prolonged inflation for a long period of time, uh, equity will underperform the long term inflation. So equity are not really a guarantee to always protect from raging hyperinflation for long periods of time. But yes, to a certain extent, equities are great hedges, provided that you select properly.
So I'm curious, you didn't mention about REITs. Now, REITs, they are historically known to be one of the best inflation hedges.
So, okay, partly because again, there are different types of REITs with the underlying assets being different for each of them. So there can be commercial property REITs, there can be farmland REITs, there can be even tourist lodges REITs, and even there is cloud data center REITs. So really, all REITs might be real estate investment trust marketed as one, but not all of them are similar. So uh, anything that has, again, the same thing, depreciation. So any REIT whose underlying has a benign depreciation compared to the capital investments, that is better. So for example, farmland, timberland, kind of a REIT will always be a better bet than, say, a tourist resort kind of a REIT. But then, if you do not really have a choice, go for the real estate exposure that you have. At least it's going to grow compared to companies who actually fall during times like these, because let's admit it, inflation is not the only problem that has come through. It is the overall sovereign risk that has come through, including the credit spread explosion that has come through. So Sri Lankan companies are suddenly are being perceived as very, very risky, even though whatever their fundamentals might be, they might not be as risky in other times. So as a result, their stock prices fall. So it's basically anything that protects your purchasing power plus protects and gives you a nominal growth is great. So yeah, REIT is a great option. If you have any, that's great. If you don't have any, then at least try to get some real estate exposure by yourself. But yeah.
Right. Now, about the REIT experience here in Sri Lanka, the SEC amended the unit trust code in August 2020 because regulators felt that it would be easy to implement. I mean, they can implement it faster if it comes under the mutual trust structure. Because I think the countries like Australia and Singapore, they have taken the similar route, whereas
Mhm.
countries like India and Pakistan, they have rather than taking the mutual trust route, they have
Yeah,
try to take REITs as a separate product, with separate regulatory framework. So
yeah.
it has taken time. So that was the idea behind going through the mutual trust route. But the problem is there's a 4% stamp duty that needs to be paid to the provincial council.
Hmm.
So this is huge, because if you are talking about a 7% yield and on top of that
Yeah,
another 4%, that's
yeah,
a lot.
yep,
And so this is going to bring down the yield, and this is an
yeah,
disincentive, incentive for both owners and the REIT holders.
yeah,
Now, I remember in 2015, the fiscal budget proposed to remove the stamp duty for listed REITs. Now that was hoping to, implement REITs very soon in the market, but it never came to fruition. Now, mainly because the stamp duty that comes under the purview of the provincial council and not under the purview of the parliament. And stamp duty is one of the largest revenue sources of provincial councils. So this is where the problem arises. Now the SEC and the Colombo Stock Exchange, they are formulating different models to overcome this challenge. And of course, in
yep.
addition to that, there are few other regulatory concerns that kind of impeding the implementation of REITs in Sri Lanka. I mean, ideal
Yeah.
time to have REITs, in times like this. So, how is the REITs experience in India? How long has it been implemented? How's the take up has been so far?
So REITs are in India are a new product, and so there are two aspects to it. The first thing is the overall sophistication index, if I can put it like that, of Indian investors are not really that much. Plus, the product choices are not very high. We have got some investment trusts as well, InvITs. So we have got a combination of commercial properties coming together as REITs, and they are being securitized and sold as paper. But overall, the idea over here is, I mean, yeah, REITs are good, but it's very boring. So, so, so that's the basically the idea over there. Uh, on top of it, I think the fixed income nature of REITs are a concern, because again, India and Sri Lanka might be different in these times, but both are emerging markets and with a high baseline inflation. So
Mm,
fixed income, having basically an fixed income like exposure in the portfolio does not really gel well that much with the Indian investors, especially when the flows are not getting directed, when it has not really captured people's attention. So, what really have what the investors really have on their side is the fixed cash flows, and that is not really cutting it for them. The day when real estate investment trusts start behaving like real estate assets, like the underlying assets, which is a combination of both fixed income plus equity portion of it, as we are taught in academic courses and syllabuses and CFA courses and all those things. Uh, but the day that happens, investors will wake up to it. But right now, the overall appeal is a bit muted.
I see. I see. Interesting. Right. So now my second question. Uh, Now, countries with stubbornly high inflation, that of Zimbabwe, Venezuela, uh, which asset classes have performed well in high inflationary times?
Okay, again, I'll just go back and circle back to the original, to the answer that I gave a few moments back. Was this that equity market performance really is a downstream effect of how society operates? Societies with high inflation for a long period of time, those societies see a widespread mass scale erosion of trust, and as a result, uh, equity cannot really give that strong a shield from from the inflationary forces that ravage a society. So I'll give you an example of Zimbabwe. Now, in the Harare Stock Exchange, uh, the stock which has really performed the best is a departmental store, which which basically sells and supplies food and grocery and things like that. Now we are all aware of how much the inflation has been on a annual basis for Zimbabwe. It's an astronomical amount. But when you compare the performance of a particular stock like this, you will understand that inflation wins that war. So the best performing stock was just grew by 4x in 5 years, I think. Uh,
4x
so
in 5 years. Okay.
yeah, yeah, it's Zimbabwe. Venezuela saw something very similar where stock exchange ceased to exist metaphorically, not literally, metaphorically, because the only thing happened in stock exchange was the trading of government securities. The exchange rather only had government security trading, and the daily volume in the stocks really went, it dropped off a cliff, and whatever was being traded was traded in American exchanges via ADRs. So for a long period of time, 2013, 14, 15, 16, 17, and stretching back to 1999, 2000, 2001, 2, 3, all this time, you can see most stocks have absolutely zero volume and flat price movement. I mean, there was no price, no, there was no trade that was happening actually. So, so off late though, the companies that have started making a comeback is so banks have started making a comeback again, a service oriented fixed asset light company. It's Banco Caracas, which has been making money. And the second best company that has uh, posted the second best results is a real estate management company. So these are the two societies where inflation has been very high for very long periods of time. Then there are countries where inflation has been high for some period of time. Take Turkey, for example. So in Turkey, the best performing business was again, no surprise, a service based company, banks. So the name Bankasi is Turkey has been a blockbuster performer in Turkey. It has gone 4x in the last 5 years. And mind you, Bankasi is Turkey has posted this result in an inflation environment which is far closer to Sri Lanka than Zimbabwe or Venezuela. Turkey is showing 38% inflation rate. Now, if I have my numbers right, because this is the number that I've been seeing it from the usual macroeconomic sites. Then there are other real estate management company which has gone up not so much, 1.5x in 5 years. Uh, India during 1970s had persistently high inflation, and what performed was again brand related products, brand related companies, companies which had a huge amount of intangible assets in their balance sheet, companies which had very strong brand recall. Think Ponds. I'm not quite sure if Ponds, if Sri Lankans
Oh,
are
it's
familiar with Ponds or not. It's
yes.
the mass market, mass affluent cosmetics that every Indian used, including me. I mean, my mom made me do it, but yeah, Ponds. Think Lipton, the tea, the premium tea that you will be serving your guests with if you want to impress them. Think Colgate Palmolive, the premium toothpaste that India brushed with. And when I say this, today Colgate Palmolive has become really mass market, mass affluent thing, very widely affordable and things like that. But Colgate Palmolive was at that point of time a foreign brand. And we did have or a lot of Indian brands, but Colgate Palmolive really took the cake. Think about MNCs like Ingersoll Rand. So Ingersoll Rand, and then there were companies. There were many other companies as well, including Gillette and all those things. Many times, companies like these have very strong brand names, and these brand names are really they stand very well during inflationary times. US saw a very strong upsurge in the 1930s in the fixed asset in the FMCG based companies, and because FMCG based companies uh, use the advertising and marketing agencies a lot, they had pretty good timings. So one interesting point that I kind of missed out for Zimbabwe is this thing, because we have been talking about equity, but it is not always necessary that what makes money is always there in equity side. So for Zimbabwe, at least one personal account was that all that they made money during in Zimbabwe was farmland, agro warehouses, and second-hand cars. So, yeah, there you have it.
Oh, okay, okay. Why second-hand cars? Because I mean, did they have a BOP crisis and the government impose restrictions on vehicle imports? Because if that is the case, then the situation hits close to home.
Yeah, it's very much okay. So, I mean, funny you mentioned it, because uh, again, inflation or macroeconomic problems do not come in isolation. They bring all their friends and family together. So, you want to, have inflation controlled. You would like to bolster your foreign currency reserves. You want to bolster your foreign currency reserves. You would not like to import. Zimbabwe doesn't really have a lot of manufacturing industry with it. It has a lot of raw material mines and all those things, but not value addition, those kind of industries. So it had to import a lot of cars. So you get the idea where I'm going into. So once capital controls came in, all that you are left with is second-hand cars, because a they are utilitarian, they are functional, people need it, and second-hand cars, you know. Uh, there's a scarcity of it. Plus, what's better is that, again, if you take a look at a car's depreciation schedule, so most of the depreciation happens in the first 3, 4, 5 years.
Oh,
So,
oh,
so, so yeah.
yes, yes. Right. So let's move to the next question. Well, Soham, now I would like to look at asset allocation strategies for different type of investors. Let's begin with institutional investors. What in an environment like this, in an environment where inflation is stubbornly hot, what kind of an asset allocation strategies would you prescribe for an institutional investor?
Very interesting question. Thank you. Uh, okay, so the way I see it in my mind's eye about institutional investors, they are sophisticated, they have a staying power, and they have a decent portfolio size. Now, if these three things are to be put together, then such an investor, must really position their portfolio by peering into a Sri Lanka that is 18 to 24 months from now. You cannot really invest keeping today in mind. So we have to imagine how Sri Lanka will look like in 18 to 24 months' time, and then take a call. Now there are a lot of moving gears, and the the developments are on towards resolving the current crisis. And I personally am hopeful because talks with IMF are on, and on IMF study says that the median debt haircut that happens during these kind of crisis is at least, or on average, 50%. So half or 50% debt reduction is on the cards. But the catch is, again, the time to resolve it takes time. So it's about 2 years. So again, it gels well with how basically Sri Lanka will look like 18 to 24 months of time, in 18 to 24 months. So now, if we are to assume and understand and think that Sri Lanka will come out of this once in a generation, once in a lifetime crisis, then one must basically position their portfolio towards that kind of a world. Distressed assets, for example, real estate oriented distressed assets, for example, luxury upmarket properties, your distressed corporate papers, corporate real estate. All of these are down in the dumpsters right now because there is no consumer demand, because GDP has fallen off the cliff, and the entire works. Once the crisis starts resolving, consumer confidence will slowly come in, credit spreads will tighten, and what will happen is that these kind of assets will perform well. Now, the reason that I'm trying to bring luxury upmarket properties is because post World War II Italy saw a huge demand destruction as well as supply destruction, and there was wartime shortages and everything else. Now, of course, there was a European reconstruction package that was given to Europe, and as a result, anyone who has basically invested in these kind of pro-consumer demand asset classes made money. So you really have to. So an institutional investor really has to take a call as to what kind of Sri Lanka does he or she envision. My opinion is this thing, that of course consumer demand will not be really going gangbusters. It will take a lot of time for this entire thing to wash away, but at least Sri Lankan society can start limping back towards normalcy. So that's the point. So even if these asset classes are not really possible for you, investing in farmland, timberland, agri warehouses makes a lot of sense, because again, uh, between a debt reduction to normalcy, it will be a long drawn protracted kind of a path. And yeah, that's that.
Right. So I'm going to backtrack into some of the equity themes you recommended. Now, you suggested in times like this, consumer staples that have a strong brand name. Having a strong brand name means you're going to have a greater pricing power.
Yeah,
Uh, so
hopefully, hopefully.
so that would be a place to be in. So other defensive sectors like let's say utilities, healthcare and pharma. Uh, what do you think about these sectors? I mean, would you invest in these themes in times like this?
I do not really like to take note of a bunch of sectors together and call them defensive sectors. In fact, I go the opposite way, where basically I unpack individual sectors and try to find out the difference and similarity between them, between the component companies. So I will not really call something as pharma, but rather it depends upon what kind of a pharmaceutical company is it? Is it Is it a bulk drug manufacturer slash generic manufacturing company? Is it a API manufacturer? Is it a trading company? Things like that. Is
And
it
what
an
we
export
have,
oriented countries? So yeah, you were saying something.
so what we, when I say pharma distribution, the companies that we have here, they're mostly into pharma distribution business. You know, they
Okay.
bring down the generic and the branded products and they would distribute you. So they have their own distribution arms. And in addition to that, we have seen some of these pharma distributing companies, they have gone downstream and started producing their own both generic and branded drugs. So
Yeah.
in a situation like this, what would you say is pharma place to be in?
Yeah. Yeah. So pharmaceutical companies who have started going downstream and manufacturing their own drugs, uh, they have made a lot of money in Indian markets. And together with banking and IT, pharmaceutical companies are termed as a third asset light company. They have huge ROCs, they have very high return on capital ratios, they have very good. Inherent attractive economics. They earn in dollars, they spend in rupees, Indian rupees, and so on and so forth. But bringing that perspective to Sri Lanka might not be a easy task, because India is a very much export oriented market, whereas Sri Lanka might be just getting into
Yeah.
those things. Yeah.
Yes.
So
Yes.
so
Pretty
what
much
I would
local
say.
domestic market focus. Yeah.
Right, right, right. So, what I will say is this thing, that one really needs to take a look at the individual portfolios of those companies. So, I would not rather draw a generic conclusion from that, that hey, pharma is good, this is bad. But I will say is this thing, that what kind of drugs are they making? Are they making the nth copy of a completely ripped off generic drug, or they are making something that is basically not made by anyone in Sri Lanka? So, in either way, are they basically acting like commodity suppliers?
Mm.
You know, the nth copy of, say, for example, something like something like a salicylic acid, acetyl salicylic acid, that is Dispirin in India. Basically, it's a headache medicine. Or are they kind of making something like a hard, something like a cardiovascular drug, or something like a cancer drug, or something like metformin, something like that. So it depends. It depends. But either way, there will be a certain margin for these pharmaceutical companies, and it needs to be assessed whether they can protect these their margins in times of these inflationary times. Because will they be able to raise their prices or not? And to really raise the prices, you have to ensure that you have a captive market with you. So it's a bit more complicated than that. But yes, pharmaceutical companies do deserve our attention. If Sri Lanka is building one like that.
Yeah.
You would also ask me about utilities. Now, utilities
Utilities.
have,
Yes.
yeah, you also asked me about that. Utilities have a very fixed income cash flow type of revenue stream. People are not going to, people are not going to cut off their electricity bills, electricity lines, water supplies, and things like that, just because inflation is there. But their ability to raise the prices becomes a little crimped. And the reason why it gets important to raise the prices is because, say for example, an electricity unit costs 7 Lankan rupee, 7 Lankan rupee in 2012. Today, if it cost merely 10 Lankan rupee for the same unit, then the utility company has really lost its purchasing power. But unfortunately, for many reasons, utility companies cannot raise their prices like that. They cannot really call it as 300 rupee, 300 Lankan rupee for per unit, because they have a social responsibility as well. So I'm not very much in favor of utility based fixed cash flow in stream revenue companies. So yeah,
Right. I think, okay, maybe now that you said that, now, given that the government's need for cash, the government is cash strapped, and I remember reading recently that the government payment dues for the renewable energy company. Now, when you say utilities, what we have is mostly the renewable energy companies here, that of wind, solar, and hydropower. So 13 billion dues from the government. So I think that is also
that explains
uh,
a lot, right?
very, yeah,
Yeah, because see, understand this point. If in a way the utility companies have really lent to the government 13 billion rupees, now in inflationary times, the the entity who has lent money is really the loser, because again the same 13 billion rupees is going to come back to them, but with a much lower purchasing power.
purchasing power.
Yeah.
Sure.
So yeah, uh, it's a hard sell at this point.
Right. So now that we have looked at asset allocation strategies for an institutional investor, uh, now let's move to retail investors. Now, retail investors, they do not have deep pockets, no holding power like institutional investors. So, what is your recommendation? What's your asset allocation strategy for a retail investor?
Yeah. So yeah, so retail investors are really hobbled by their lack of staying power. Most of the time, energy and money goes and will go into putting bread on the table, at least during these inflationary times, which is a very sad state of affairs. But of those who are slightly better off, getting exposure to real estate makes a lot of sense. Even if one can be part of a cooperative society, we in India do have the ability to form cooperative societies. That is, a bunch of people can come together and draft a common objective and fulfill that objective. I'm not quite sure if Sri Lanka has it or not, but I'm hopeful that they do. They should have something like that.
We
So
do have cooperative societies, but in terms of societies coming together and collectively purchasing land parcels, that I am actually not very familiar with it. But interesting point. I'm going to look into
yeah,
that.
yeah. So the cooperative societies can really come together and purchase those land parcels, and so one should go for them if they can. If such a cooperative society can also strike contracts with farmers for produce, then they are better off. But survival strategy aside, gold, especially metal, becomes the go-to investment vehicle for retail investors during times like this. Gold in terms of USD may not be performing well, but don't let that hold you back. In terms of INR, they are trending up, and I'm pretty sure in terms of Lankan rupee, they will also be going gangbusters.
It
One
is,
can
it
take,
is especially with the rupee depreciation. Yeah.
yeah, yeah, yeah. One can also take a look at precious metals like platinum, for that matter. So the bottom line is agriculture, real estate, and real estate. I mean something like a productive real estate, like agri-land and precious metals. At least till the tough times do not relent. In the horizon of 18 to 24 months, as Lanka comes out of this entire lifetime, once in a generation crisis, one can start thinking about taking incremental risks, anything to basically grow that lost purchasing power. But yeah, till the times don't relent, agriculture and precious metals.
Okay, so the Lankan experience in terms of investing in gold, it's a very popular asset class here also. Now, there's a lot of sentimental value attached to it, just like in India, and also in the farming community, they use these jewelries, especially during cultivation times. They would pawn it, get their lending, do the harvesting, and then they would go and repawn it. Rather, they would take the jewelry back. But my concern is in terms of liquidity. There is not a lot of liquidity, and especially when you try to sell it, there's a significant illiquidity discount attached to it.
Yeah, yeah.
Perhaps it may not be the case in India, I believe, because there are a lot of gold-based instruments there. You have gold-based ETFs, but we still don't have that kind of products in this market. So, what do you think about gold as an investment in that light?
Right, right. Liquidity, or rather the lack of it, is a big problem for those who want to make quick trades. And when I say trades, I don't really mean trades only in the capital markets, but also in real life. You want in, you want out, you would like liquidity to it. But for an investor who is going to really spend his 18 to 24 months period buying and keeping gold, illiquidity, yes, it's going to be a cost, but he will have to bear it. And if by bearing this cost, he's also able to protect his and preserve his purchasing power. Nothing better than that. So you get the idea. Uh, Gold is illiquid, but illiquidity is a cost, and liquidity is a luxury that we cannot really afford to bear.
Right,
Yeah.
right. So I think with that we have come to the end of our first session. We've covered a lot of grounds. We discussed about why it is important to look at economic profits, especially in high inflationary times, versus accounting profits, and also global experience in countries where inflation was stubborn, was and is stubbornly running hot. Countries of Venezuela, Zimbabwe. What other asset classes have performed well? And next, we looked at in terms of asset allocation strategies. What would be the strategies for institutional and retail investors? So next, we are going to the second part of this discussion, the light-hearted questions, where we're actually going to understand you as a person, in a more deeper way. So I know that you're a voracious reader.
I try. I try to read
So
and keep better updated.
how many books do you try to read? Let's say like per year.
Oh,
Do
I
you
do
have
not.
like a goal like that?
No, I don't know. No, I don't count like that. Neither do I have a goal like that. There are times when I revisit the same book, and I do not really believe in. Well, I can speed read, but I don't believe that speed reading is necessarily a good thing. The ideal thing one should do is really take a book, lean back, you know, stare at the ceiling and read every one or two sentences and then think, because uh, we have been kind of brainwashed into thinking that reading a lot of books is great. I believe that reading a few books but in a very deep, innate, introspective way is far far better. So yeah, I don't have any quantitative numbers in my mind for that. Yeah.
I also actually echo those women rather than having like a goal. Like I also when I try to read a book, I try to get immerse myself in that book, and I take a lot of notes if I do like it. Okay, talking about notes, what helpful methods, systems have you developed over the last few years in terms of greater comprehension, trying to remember the things that you read in books?
I don't have any. I mean, I know people have come up with very interesting note-taking, note-taking systems, but unfortunately, I don't have any. Uh, it's if I have a hard book with me, I like having a thick marginalia, and because I can go to town with the pencil on that. I'm a very voracious scribbler, and people in my family do not really like that because they like to keep their books neat and tidy. I personally am against that because I feel that in a way, I have got a lot of grief on that. But I once said that you should really make love with the book. So uh, you know uh, I really go to town with a highlighter, with a pencil, even with a pen, but I scribble a lot. If it is on Kindle, then what I do is again I highlight a lot, and uh, at times, depending upon what I feel and how important the book is or how interesting the book is, I do take notes in free and open source software called Obsidian. Obsidian
What's
is
it?
just a
Obsidian.
Obsidian, Obsidian.
Okay.
It's a free and open source version of the famous Notion
Oh,
software.
right, right. So is this like like Notion 2.0, kind of like advanced version of it?
No, no, not really, not really. It's really it's really is an open source version of Notion, as in like people have kind of copied the features of Notion and put it and coded it and built a fresh new software and called it Obsidian. I'm pretty sure
Nice.
that Notion has kind of, pulled itself apart in terms of features and in terms of its rich functionalities from Obsidian. But for me, Obsidian works. I don't really need a lot of rich features. I'm good with it.
I'm gonna try that because what I usually do is I scribble on a book, and then I would I mean, earlier what I used to do was I used to translate to a Word document, but now I actually translate to Notion. But I am going to check on this new Obsidian.
I think if you have Notion, Obsidian is not going to really impress you. I don't have Notion, so I stick with Obsidian.
Okay, okay.
Yep.
So yeah, the big question is, what is your favorite book recommendation for an investor?
I think because our conversation has been so finance/investing oriented, and I read a lot of books spanning from history to uh, technology to sociology to medicine to finance and back to technology. So I'll not really go over there, but I'll really offer a book called Debt Companies Walking. It's a book written by Scott Fearon, and if you bring the presentation up, then I can share with you the
Yeah, we'll be
uh,
displaying it.
right. I can share with you the cover page of it, and it's a very nice book where even institutional investors as well as the retail investors can read and understand what really goes on in the minds of hedge fund manager. So it's a very interesting book, and it was very nice for me. It was a very nice read for me because I learned personally quite a bit. Uh, One quote I remember from that book was, "I'm not perfect at what I do by any stretch, but I'm a very good quitter. I'd say I'm one of the better quitters I know." I'm not going to reveal the context behind it, and I would really invite the audience to read through it because quitting is something that I learned after, or rather, consciously tried to pick up after I read through this book. So yeah, I will say that it's a great read for institutional investors. It's an equally good read for retail investors. They will at least learn how professionals do it. So, and how sausage is really made behind the scenes.
Oh,
So yeah.
sausages are really made. Yeah, nicely put. Okay, so you said, I'm going back to the quote you said. So, would you say that you are a good quitter when it comes to a bad book?
See,
Or you're a person who would, still continue to read, if the book is still
I
bad?
understand. The catch is this, that most books that I come across have been recommended by a very close circle of friends, and those circle of friends have very similar tastes uh, in terms of not interests, but in terms of their hunger for those insights and aha moments. And so it doesn't really matter if it is from medicine or if it is from sociology. As long as there are aha moments over there, I'm game for it. But then there are books which I think that they are overrated, or I think I'm not really able to crack through it. I keep it aside. I do not really go back. So one book that has been there on my bookshelf for, I don't remember when, I think 4, 5, 6 years. So called Blood Meridian. It's a masterpiece in itself.
Sorry,
I
what's
can
the
feel
name?
it's Blood Meridian. BLOOD Meridian.
Okay.
Meridian. It's written by Cormac McCarthy. So it's a masterpiece. I can feel it, but I have never been really able to penetrate through it. I pick up, try to browse through the first. I try to read the first 6, 7, 8 chapters, and then I again quit it. So, yeah. But it has a very different way of writing. So that is something that I'm not really able to penetrate one of these days. So
Been
yeah.
there, done that. I feel you. So we've been actually brainstorming about this podcast now for a few weeks. And when I told you that, in the second part of our session, I'm going to ask from you what your favorite book recommendation is, and you told me it's going to be Dead Companies Walking, and I started reading it, and I absolutely fell in love with it. And
My
I think
pleasure.
this is, thank you. Yes, yes. I think this is one of the best investing memoirs I've read. And I really like how he surgically analyze and diagnose dead companies, the companies that are about to
Indeed.
go bankrupt. And I think that line of thinking actually helped me as an analyst also.
Yeah.
And I also like the level of humility he displays, especially in acknowledging some of his investing failures.
Yep.
So yeah, yeah. So I think all in all, I mean, it was a very joyful and a very intellectually stimulating read.
Good to know. Good to know.
Yeah, thank you. Yeah, you are going to be, one of my, a go-to person for book recommendations.
Thank you.
So, we are going to go to the next question, which is our last question.
Okay.
Yeah, so uh, okay, let's say, you were to host a dinner party, and who's your favorite person to invite for that? Now, in other words, what I'm trying to understand is your most admired person, the person whom you always look up to in the industry. So, who that person you're going to invite, if you're going to host a dinner party?
It's such an interesting question because I have this kind of a this idea slash principle that never meet your heroes.
Never meet your
So
heroes. Okay.
never meet your heroes. They will uh, they will almost always disappoint you. But and this is one of the reasons that I don't really have a hero per se in my head, in my mind. People to emulate, yes, but not a hero. Um However, I think I'll stick my neck out, and I would like to invite Mr. Ashish Kacholia to it. Ashish Kacholia is an Indian investor. It's an Indian small cap, mid cap investor, and he is a singular investor who believes in maintaining an extremely down to earth, low profile in spite of his countless successes. A man half his wealth and one third his intellect would spend his entire time tom-tomming his success and hogging limelight. But not Mr. Kacholia. Uh, he believes in making his actions speak louder than words and is rarely visible on mainstream media. In fact, even alternative media. He is there on Twitter, but he never talks about finance. He talks about bird watching, sports, and things like that. But behind the investor, he is a person with a deep, deep liberal philanthropic bent of mind. He is one of the single largest individual donor to a philanthropic uh, philanthropic initiative called Caring Friends. So Caring Friends basically brings NGOs and donors together, and Caring Friends doesn't charge a single Indian rupee from either party. So 100% of the donations goes to the NGO. So his pet cause is education of the underprivileged children, and more, or rather more than the finance aspect of it, I'm far more interested in hearing and listening his thoughts about philosophy, life, uh, how India lives, and how India uh, spends its or what dreams and ambitions do the most underprivileged part of India look or see. He's the son of the social luminary Mr. Ramesh Kacholia, and to be very frank, he's a proof that the Kacholia family has been a net blessing for India. Uh, I I hope that basically I'm able to basically leave that kind of a mark when my time is up on the society in which I'm living. So yeah, it'll be Mr. Ashish Kacholia.
Beautiful, beautiful. And also about that dinner, I think you should go on with it because I know that you are a very good cook. We only have to get those plating side of the the
So
skillful
you have
plating.
only Baji, you have only heard it from my mouth. Wait till you actually try it, and then I will hear your verdicts. Yep.
I definitely look forward to once
But
dust
thank you for
settles, once we use our own.
but thank you for taking my own verdict on the face value.
I do that. I do that. So this is great, Soham. I really enjoyed it. Discussing about this very timely topic, and also goes without saying, I really enjoyed the second part of the session also. It's an absolute joy to speak with you. I've been following you on FinTwit for a long time at Soham Das, and
Yep.
I always want to pick your brain, and I'm so glad that
Thank
you
you.
joined as the first guest of Rational Investor.
It's an absolute pleasure and an honor to have been the first guest of Rational Investor, and it's a really great joy to having to be for this conversation where we were able to kind of exchange our stream of thoughts on such a
Absolutely,
pertinent topic. Thank you for that.
absolutely.
Thank you for this opportunity.
So I wish you all the best for your future endeavors.
Thank you.
And I also look forward to having the opportunity to do another episode with you in future
Oh,
in a
thank you.
different
Mm,
topic.
thank
So, yeah. So, again, dear listeners, thank you for joining. We'll see you again in another 2 weeks' time with another exciting and a timely topic.